Now, barter. I was mentioning barter earlier. It's very hard to hold a economy to barter because it is difficult to pay somebody in a product and they may not want that product. But bartering kind of works like this. It's kind of like it's a trade system. Let's say I was trading groceries and I was given a bunch of canned goods. And that was my trade. I work a day, I get a day's worth of canned food. Well, I don't want all that canned food. So I take the canned food and I might barter for a pair of shoes for my son. And I might take another bit of canned food and I might barter for a pair of work gloves. And so I give it to a person who actually has work gloves. Now they have the canned food. Now they can trade the canned food with someone else, or they can use the canned food for themselves. And that's kind of a barter network. And you can actually have barter going all the way around. There was a movie way back, and I think it was...
Here's Roger.
George, can I have my Bronco back? I don't have any cash right now, but I need my car.
Well, I need some solar panels installed on my roof.
I don't know anything about solar.
Well, Charlie Shepard does, and he needs a well dug on his property. You help him dig the well, he'll help me with the panels, and I'll fix your car. Deal?
Yeah, deal. I'll call Charlie.
And it keeps trading in like a carousel to get what he finally really wants. I think I've seen this also on an old MASH episode in which people are trading for things to get what they want at the very end, and it takes a long process. Bartering is great if you want to trade straight across. And that's why I love the craft fair when we had it, is that you could actually trade your product that you made for another person's product of equal retail value. And it may have cost you $3 to make that product, but you're buying a $15 product. Well, it may have cost that person $3 to make their product. So you're trading straight across. So like you might have someone that's made fudge and they're trading that fudge for jewelry. And maybe it takes 3 pieces of fudge to buy one necklace. And so the person here says it's a deal. The person here says it's a deal, and it works. It's a trade. So what are some items that you actually have bartered for in your life? And then how did you barter and come to a fair trade with your bartering? I'm kind of curious if you've ever experienced a barter situation in your own life. So let's use that as a discussion. The next word I want to talk about is the Federal Reserve System. And I've kind of been mentioning this a little bit. It is the central bank, and it is our monetary authority of the United States at this point. The Fed prints the money, and that's the nickname for the Federal Reserve, is the Fed. Prints the money for the United States. It is also a private bank owned by private investors. So we're not allowed to know exactly who owns that bank. And part of the reason that they wrote that, I believe, into law and have kept themselves secret is they're afraid. I mean, think about it. If you were a person that actually controlled the entire nation's money supply, and you could print as much money as you want, or even type onto a computer how many zeros in anyone's account that you want, it would be very easy for someone to do you harm. Try to hold your family ransom, to get kidnapped, and then they could force you to print whatever money they want. So I think that's one of the excuses that the owners use, is they don't want to be attacked like that. But also what it does is it gives some anonymity to it, to where they can't be held accountable for any irresponsibility or overprinting they may do for themselves. So that's a real serious issue that needs to be taken into account. So the other thing I would like you guys to think about is, to whom does the Federal Reserve actually answer? The government, the taxpayers, Wall Street investors? Who? Who is in control of the Federal Reserve? This is the nation's money supply. We elect our politicians. We vote for them. But the Federal Reserve is not elected by anybody. They are appointed by the investors, the private investors that own the Federal Reserve. So the United States has a say, and we can appoint who the Federal Reserve chair is, and even have a say in who's on the board, but someone gives us the list, and the president must choose off the list that the Federal Reserve gives it. So, I mean, think about it. Oh yeah, you have freedom to choose the chair, and here's the 3 people you can choose from. President cannot choose anyone that they want to put on the Federal Reserve chair. They have to choose one of the 3 people that they're given on the list. That's it. So how is that Think about that. So who are they responsive to? Who's the Federal Reserve have to answer to? And I have two videos here. And this video that I'm going to play with Alan Greenspan is an interesting video. And just to let you guys know the history of this video a little bit, is that my wife and I were sitting on the couch. This is over 15 years ago, and I'm watching this interview with Alan Greenspan. It was on, I think, PBS, and I don't watch news on PBS, but sometimes I do. It just happened. I flicking the channels, and I see Alan Greenspan there, and my wife was over there, and very quickly, here these guys are talking. She starts drifting off and falling to sleep. And this clip, I can't believe it. I actually saw this clip and heard these words come out of Alan Greenspan's mouth. And I went, oh my gosh, did you hear that? And I'm kind of poking my wife with my elbow going, did you hear what he just said? And she goes, what? I didn't hear that. And I was like flabbergasted that he actually said that. And the fact that I remembered it and was able to find it on YouTube is, it's a miracle. But the thing is that clip keeps getting taken down. It's really hard to keep finding it because it keeps getting buried or demonetized or flagged or whatever. So I'll put that video clip in here for you guys to see.
What is the proper relationship, what should be the proper relationship between a chairman of the Fed and a president of the United States?
Well, first of all, the Federal Reserve is an independent agency, and that means basically that there is no other agency of government which can overrule actions that we take. So long as that is in place and there is no evidence that the administration or the Congress or anybody else is requesting that we do things other than what we think is the appropriate thing, then what the relationships are don't frankly matter. And I've had very good relationships with presidents.
And then here's a clip with Ben Bernanke, who is facing off with Bernie Sanders. And Bernie Sanders is calling him out for the bailout that they gave to banks. And we're going to talk about that bank bailout. And it is crazy. The amount of money that bailed out the banks, the United States could have paid off everybody's house. Everybody could have had their home loan forgiven. And what they do is they could take what the government could have done is taken their money, given it to the homeowner. The homeowner would own their house, and then they would put the money, they would be forced by law, by decree, to pay the bank off their mortgage. So if you lost your job and you couldn't afford your house, you would get to keep your house. It'd be yours. You'd own the title. But the bankers screamed and said, you can't do that. You can't do that. If you do that, we're going to have hyperinflation. Okay? So the government said, well, what do you want us to do? Well, here's what you're going to do. Give us the money. We'll take the bailout. It'll keep our company, our banks afloat. We'll foreclose on the homes that can't pay. And then we'll resell those homes at a lower rate. And that will prevent hyperinflation. Because they believe in a term called scarcity. And we're going to talk about the theory of scarcity in another vocab set. Think about that. Can you imagine if everybody in the United States owned their home? What do you think would have happened? Do you think you'd see all the homeless tents around? Something to think about. That's a good discussion question. I'd like to discuss this with you guys, see what you guys think is going on, and maybe even discuss the theory of scarcity before we even get there in that next vocab section.
We have spent a lot of time in Congress talking about the $700 billion TARP bailout, which I voted against as it happens. Not a whole lot has been talked about with regard to the $2.2 trillion that the Fed has lent out. Now, I find it absolutely extraordinary that I wrote you a letter and I said, hey, who'd you lend the money to? What were the terms of those loans? How can my constituents in Vermont get some of that money? Who makes the decisions? Do you guys sit around in a room? Do you make it? Are there conflicts of interest? So my question to you is, will you tell the American people to whom you lent $2.2 trillion of their dollars? Will you tell us who got that money and what the terms are of those agreements?
We explain each of our programs. In terms of the terms, we explain the terms exactly. We explain what the collateral requirements are. We explain what
To
the
whom did you
rates are.
explain that?
It's on our website.
Yeah, okay.
So all that information is available in our commercial paper
And
program.
who got the money?
Hundreds and hundreds of banks. Any bank or that has access to the U.S. Federal Reserve's
You
discount.
tell us who they are.
No, because the reason that it's counterproductive and will destroy the value of the program is that banks will not come to the discount.
Isn't that too bad?
Sorry.
In other words, isn't that too bad? They took the money, but they don't want to be public about the fact that they received it. We heard a whole lot about AIG. They're on the front pages.
These are very
Now, I
short-
got banks and I have businesses in the state of Vermont who are in a lot of trouble. Not banks. Our banks, by the way, are doing pretty well. Now, how do these guys who are honest business people get it? Do you have to be a large, greedy, reckless financial institution to apply for these monies?
There is no subsidy, there is no capital involved, there is no gift involved. It is a collateralized, short-term liquid loan that is both over-collateralized and is recourse to the company itself. We have never lost a penny doing it.
And how can other institutions get those loans as well?
According to the law, we are supposed to be lending to depository institutions.
Well, let me just say this, Mr. Chairman. I have a hard time understanding how you have put $2.2 trillion at risk without making those names available, those institutions public. And we're going to introduce legislation today, by the way, to demand that you do that. It is unacceptable to me that that goes on.
All right, the discount fund rate. The discount fund rate is the interest rate that the Federal Reserve influences as the lowest possible interest banks may borrow from the Federal Reserve. So when the banks borrow from the Federal Reserve, they need money printed for them, it's at the discount fund rate. So they have to pay interest on that money. And I think the discount fund rate, I'm not sure what it is right now. Let's look it up because we're going to talk about the, I already mentioned it, the reserve requirement and how it shifted. And I think that the discount fund rate has shifted as well. So let's go ahead and have you guys look that up as our class discussion. But you guys really need to know what is the discount fund rate, because that impacts your credit card bills, that impacts your home mortgages. Yeah. What happens if the Federal Reserve raised the discount fund rate too high? So if they raise the interest rate too high, what will happen? Okay. So I've lived long enough that I grew up as a small kid in the 80s, and I remember a home mortgage, as you guys find the home mortgage of today, home mortgages were going for anywhere from 12 to 18% for a 30-year fixed loan. Now, when you raise the interest rate like that, it takes money out of the system. So if you have too much money in the system, the Federal Reserve is supposed to raise the interest rate to pull money back out of the system to cause inflation to decrease and cause a little bit more deflation to slow the hyperinflation down. Something to think about. So the federal fund rate is the interest rate that banks charge each other for loans based on the discount fund rate set by the Federal Reserve. So banks actually loan each other money as well. So you might see Wells Fargo loaning money to another FDIC bank, and they can charge a little bit higher interest rate than the discount fund rate. And sometimes credit card companies will borrow money from banks, okay, as an investment, and then the banks will add a little bit of interest to the credit cards. And that's why credit card interest rates are always a little bit higher. But also the reason they're so high is because the credit cards see the person using them as a riskier investment. And so therefore they're allowed to punish a person for taking out a risky loan by charging a higher interest rate. But that also means they make a whole lot more money if the person is able to pay it back. So a commercial bank is a financial institution which accepts checking deposits, holds savings and loans, money at the prime rate, stores valuables. A commercial bank is usually an FDIC member. That means they have to pay an insurance to belong to the Federal Reserve. If they have a run on their bank, they can call the FDIC or the Federal Reserve and say, all our money's gone. We have no money in the vault. The Federal Reserve would quickly hit the printing press as fast as they could, print out some money, ship it out in armored trucks, and then they would be infused with money to where people could come back in their door and pull out the money. So that's the importance of having an FDIC. And I believe the FDIC has changed the limit of how much money you could have in a savings account. So as a person, this is many years ago, I could have only $100,000 in my savings account or even my checking account. If the bank closed down and they had a major problem or even went bankrupt, the amount of money they would pay me back would be $100,000. So if I had $200,000 in there, I would lose $100,000. They would only give me $100,000. And I believe that number has changed. So if you have a lot of money, I would suggest if you're over that reimbursement rate or that insured, FDIC insured rate, get a new bank. Okay? And it should be different. Even though the FDIC is a loop, if you're in a different bank, then they have to insure up to $100,000. So commercial banks also promote things like credit cards, home mortgages, home loans, car loans, etc. I will tell you this, it is very difficult to get a home loan and a car loan from a bank. It's easier to get those kinds of loans from a credit union or even from the dealership or even sometimes from the builder or realtor that is building or selling the house. The prime rate is all loans or credit to the borrowing customer is substantially higher than the federal fund rate. This is what you're given. So the federal fund rate is what banks are giving each other. The discount fund rate is what the Federal Reserve gives to the banks. And so the prime rate is the interest rate that the banks give you, the private customer. Now, my question to you is, what is the current prime rate? I'd like you guys to find that. That would be a great discussion topic and see what you think. And then I would like you guys to compare the prime rate to your savings account interest, how much money you can make on your savings account. Now, the fractional reserve requirement, we talked about this a little bit, is what is the reserve requirement? So basically I add the word fractional reserve, that 9-to-1 ratio. The Federal Reserve sets the minimum amount of cash banks and must hold 10% on deposits. This is what it was before March 26. The reserve to prevent bank failure if too many people come to withdraw their money at the same time. Now, granted, the reserve requirement has been removed. Okay, it's gone. We know that. It's at 0%. However, the bank that I was talking to, the loan officer, they're still doing it. Did you hear me on that? The banks realize there are some banks that have been in this game long enough, and Wells Fargo is one of them. And they've been watched like a hawk by the Senate lately. So just to let you know, Wells Fargo is still going to do it. They're going to probably still keep their 10% from what I understand, at least from my insider that talked to me. Because it's too dangerous, and they know it's too dangerous. So be aware, some banks are going to still meet that 10% requirement because they're like, no, this is too dangerous. This is foolish. So don't think that the bankers are all in on this crazy 0% scheme with the Federal Reserve on this. Some of them are like, we know better than that. We're not doing it. And so they're actually holding that reserve themselves anyways. So that's good news, and you guys want to hear that kind of news, that where bankers are being responsible. But there are some banks, they're like, woohoo, let's make some money, and they're off spending that money around, and they don't care about the reserve requirement because there is none. So be aware, and you might want to just check with your bank, talk to them, be very frank with the bank manager and say, hey, I noticed that the reserve requirement is down to 0%. Are you guys following that procedure, or are you still keeping the reserve requirement of 10%? And they may say, oh, it doesn't really matter, blah, 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 money's more digital. And they may give you that, leave that bank, get a different bank. New money can be credited into existence based on a bank's deposit. The bank can loan out 9 fictional dollars, which is going to become real money, 9 new dollars to $1 on hand. Okay, so 9 times that money they have in their vault is what they could do. It used to be that they would loan money out from their bank account and then they would pay a better interest, kind of like that Goldsmith's tale, where the interest would pay that person, and it was worthwhile for the person to keep a savings account with the bank because of that reserve requirement. The higher the reserve requirement, the more people want to save money. The lower the reserve requirement, the more people just spend their money because the banks don't really promote it, and they give a very small interest on their savings account, which is really, really a shame. So something to think about. You guys know what the current, for the class discussion, you guys know what the current reserve requirement is, but what does this new requirement mean? What is going to happen if we're not careful? Thank you guys for joining me at Forsberg Charter School's Teaching Beyond the Standards economics class. This is Vocab Set 1. Thanks for hanging in there and doing all the notes, and we'll be testing this Friday on these notes. Notice that the notes are trying to work in correlation with Money as Debt video that you watched, and we'll be starting another video next week, and we'll have a new set of notes after that. So thank you so much for you guys. There's so much to discuss here. I can't wait to discuss this information with you guys in class. And just see what you guys are thinking about our current economic system. Vocab 1 is pretty heavy, but it's good. You guys are getting a really good foundation to understand the economy. So you guys take care. Have a great day. See you guys in class discussion.